how to combine wave principle and divergence, part 1. How to combine wave principle and divergence, part 1. Good morning, good afternoon, good evening, bonjour, bonsoir, mes amis. Guten Morgen, guten Tag, guten Abend. For those of you who are new to us, we are the TSTW 24 traders for Elliott wave trading. Our website is www.24elliottwaves.com. The title of this video is how to combine wave principle and divergence, part 1. Okay. In this tutorial, I want to talk about a bullish divergence and bearish divergence during the first Elliott wave. All right. So if you are a day trader or a swing trader and one of your favorite trading setups is a divergence trading setup, and you want to combine the wave principle and the divergence, you want to pay attention to what we are about to discuss. Okay. So when we are talking about Elliott wave, we have during the motive wave. The motive wave is the trending phase because we have the Elliott wave cycle is formed of the motive wave and the corrective wave. All right. So during the motive wave, we have 5 waves: the first wave, the second wave, the third wave, the fourth wave, and the 5th Elliott wave. All right. So in part 1, I want to talk about divergence that usually appear during the first Elliott wave. All right. So you may be able to filter out a false divergence, temporary and also temporary divergence. Okay. I don't want this video to be too long, so I'm going to go to the point very fast. But I recommend to traders, if you have any question, any suggestion, okay, put in the comment section, but no spamming, please, okay? During the first Elliott wave, all right, we usually see 2 types of divergence, okay? The first type of divergence that we see is what we call temporary divergence. These are divergences that we can trade, but a bit risky. We need to control the risk because it's a divergence, but it's not going to last. So it's a temporary divergence. All right. Also, during the first Elliott wave, we also see what we call false divergence. And at the end of this tutorial, you will be able to identify what is a temporary divergence during the first Elliott wave and what is a false divergence during the first Elliott wave. All right. The temporary divergence usually appear when we see a normal first Elliott wave. What is a normal first Elliott wave? It is the first Elliott wave that is not extended. Now, for traders who do not know about the Elliott wave extensions, I would like to refer you to our website, www.24elliottwave.com. Click on Elliott wave extension and also click on the 5th Elliott wave extensions so you may understand what I'm talking about here. All right. So if the first Elliott wave is not extended, all right, and we have what we call a normal first Elliott wave, at the end of the first Elliott wave, suppose this is a normal first Elliott wave, at the end of the normal first Elliott wave, we are likely to see what we call a temporary divergence. So if we are in an uptrend, we will see a temporary bearish divergence. If we were in a downtrend, we will see a temporary bullish divergence. All right. So what is a temporary divergence? It's a divergence that will not last for long. Why? Because the first bias, remember, talking about the wave count guideline, we have a consolidation, or we see a cycle point, or we see an inverted head and shoulder pattern, and then boom, we see the first Elliott wave at a cycle point, or at the end of an Elliott wave cycle, we see the first Elliott wave, which is the signature of the bull in an uptrend and the signature of the bear in a downtrend, the first Elliott wave. If it is not extended, all right, at the end of that first Elliott wave, we are likely to see a temporary divergence. So what you usually see, you will see, for instance, the stochastic, which is one of the best indicators. The primary role of the stochastic indicator is to identify divergence. So probably the stochastic indicator, 833, for instance, may flash a divergence during the first Elliott wave. But you want to understand that divergence may not last for long. It's a temporary warning. So a divergence is not a trading divergence, a bullish divergence, a bearish divergence is not a trading signal, all right? It's a trading setup. Remember what we talked about, the top-down trading method. The trading setup, the signal, and a low-risk entry point without violating the market pattern and ignoring, okay, the current market environment and the economy news, okay? So if we see a divergence at the end of but what you usually see, you see that the price is out of a consolidation, and then, for instance, one example, first Elliott wave coming out of a consolidation. As soon as it's out of the consolidation, we project the size of the channel, horizontal channel, we project it 3 times, talking about wave genius, all right? Check it out at 24elliottwave.com, 3 times. You are likely to see after 3 times the projection of the consolidation, somewhere along here, a divergence, all right? What you need to do, my friend, is to draw the channel along the first Elliott wave, at least a trend line along the first Elliott wave, and you want to see whether if there is a divergence and the trend line is broken, you will use a top-down trading method here, okay, to enter the trade. You need to be very careful. Why? Because if you are in an uptrend, the first wave is the signature of the bull. So if you are trading a bearish divergence, at the end of a normal first Elliott wave, it's a temporary divergence, but it is also a counter trend. It's a risky trade. Price is about to go up, but you want to sell. Okay, you have 2 options. You may decide not to trade it at all because you know that a third Elliott wave is soon to begin to start at the end of the second wave. Or if you want to trade it, it's quite risky. All right, and it is also temporary. All right, why? The second way, because if we see a divergence at the end of the first Elliott wave, for instance, first bullish wave, we see a bearish divergence at the end of the first bullish wave, all right? We see a bearish divergence, and we want to trade it, we use a top-down trade method. We want to know, one thing you want to be aware of, it's a counter trend, it's a risky trade, it's a temporary divergence. 2 options. You may decide not to trade it at all, or if you want to trade it, you want to control the risk carefully. Very often, a lot of traders get into trouble because of the divergence at the end of the first Elliott wave. Why? The market was going down before, and then we see a correction, blah, 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 or an Elliott wave cycle has ended, and then boom, a new cycle has begun. So we see the first Elliott wave. So because the previous cycle was bearish, the market is saturated by the bear, and no one believes that a new trend is about to begin. So as people see a divergence at the end of the new cycle, end of the first wave of the new cycle, they are willing to sell and forget. But the trouble is that this kind of divergence is usually a temporary divergence if we have a normal first Elliott wave. So you want to look at your left-hand side, what has happened before the new trend is about to begin, all right? Are we at the end of a previous Elliott wave cycle before a new first Elliott wave is starting, all right? What is the current market environment? Remember, I don't want the video to be too long, so I will keep it very short. So to summarize very fast, a temporary divergence is a risky divergence that usually appears at the end of the first wave, all right, is, okay, a temporary divergence because the second wave, all right, should not cancel the first wave. Okay, so because this is one of the Elliott wave, the second wave should not cancel the first wave, shouldn't come to the, okay, starting point of the first wave, unless the fundamentals are solid. So very often if we see a bearish divergence at the end of a bullish first Elliott wave, if the fundamentals are solid and the market environment is viable, is likely to be a temporary divergence. But if we have a first Elliott wave, but the first bullish Elliott wave, for instance, but the fundamentals are weak, all right, we may see a total retracement. Second wave may cancel the first wave. So be aware of the divergence that we usually see at the end of the first wave. If the fundamentals are solid, talking about bullish first Elliott wave, all right, we are likely to see a temporary divergence at the end of the first wave. Okay? Next step, okay? The first divergence that usually appears during the first Elliott wave. By the way, this video is about how to combine the wave principle and divergence part 1, okay? So, first divergence will appear during the first Elliott wave if we have an extended first Elliott wave. So what is an extended first Elliott wave? It's the first wave that is subdivided into 5 mono waves. So you see coming out 1, the first wave coming out 1, 2, so 1, 2, 3, all right? Very dynamic and bullish. And then 1, 2, 3, 4, 5. All right. So if we have a first wave, so you remember what I said also in the previous videos, the wave count is dynamic. So we are going one step at a time. So probably when you see the first mono wave of the extended first wave, you will be thinking that this is the normal first wave. All right, you will be thinking that. But because the first wave is about to be extended, you don't know yet. And then you see 3, 4, 5. So you say, oh, this is a multi-wave. The wave count is dynamic. We are going one step at a time. Sometimes we can know, we can predict, we can forecast what the price is likely to do. But sometimes we don't know. So we just go one step at a time. But we don't want to violate the 3 market pattern. This will keep us, okay, on the right side of the market. All right, I'm talking a bit too much, isn't it? So if the first wave is extended, you are likely to see a lot of false divergences during the first Elliott wave. So you will see a divergence probably at the end of the first mono wave of the extended first wave, and you are likely to see another false divergence at the end of the third mono wave of the extended first wave. Are you getting confused? If the first wave is extended, this is the first mono wave or the first of the extended first wave. This is the second mono wave of the extended first wave. Third mono wave of the extended wave, first wave. Okay. Fourth mono wave of the extended first wave. This is the fifth mono wave of the extended first wave. But from here, from the beginning, from here all the way to the end here, this is the first wave itself, which has been subdivided into 5 mono waves. So don't get confused. So you are likely to see a false divergence at the end of the first mono wave of the extended first wave, and also at the end of the third mono wave of, okay, of the extended first wave. So what I recommend to traders is that when the first wave is extended and you know that it's extended, you may disregard any divergence that is taking place during the extended first wave. Usually they are false divergence because if the first wave is extended, it's quite dynamic. The smart money is showing their hands, so to speak, at the beginning of the trend. Usually they hide the activity, but now they are exposing the activity at the beginning of the trend, all right? They start speeding, all right, at the beginning of the trend. So they reveal their intention for us, all right? So be aware of the temporary diversion at the end of the first, okay, normal wave, and also the false divergences that appear during the extended first wave. The trouble is that these divergences are contra trend, they are against the normal trend, either in an uptrend or in a downtrend. All right. Therefore, we may decide to stay away from them or ignore them, or we may decide to trade them carefully. Okay, if we are able to filter out what is a false divergence, what is a temporary divergence. It makes sense? Okay, let's stop here. So this is the end of this video, the first part of this series of video, talking about how to combine wave principle and divergence part 1. So what is the point of this video? So traders very often will trade divergence. So they use the MACD, the stochastic, especially the RSI, and they are looking for bullish and bearish divergence because these are usually high probability trade setup. So traders go on an hourly chart, they go to the 2-hour chart, they go to the daily chart, weekly chart, looking for divergence. Maybe they have a screening software that allow them to pinpoint or to select bullish and bearish divergence stocks. As traders are not aware of the relationship between the Elliott wave principle and divergence, sometimes traders may see a divergence that is completely a temporary divergence or false divergence, and they may place a trade like they did before, and they will end up losing. By understanding the wave principle and by combining the wave principle and knowing exactly where do we see a temporary divergence, in which case do we have a temporary divergence, when do we have a false divergence during the first Elliott wave, and also combine the wave count, the wave principle, and the divergence, one will be able to make a better decision if one is a divergence day trader or swing trader. So, if for instance you have a list of stocks that you want to trade, that divergence trading setup, now you will be able to start filtering out false divergence, and valid divergence. I invite you now to follow me in the next video when I will be talking about how to combine wave principle and divergence, part 2. In part 2, I will be talking about divergences that appear during the second Elliott wave. All right? As always, for this type of series of video, I start drawing lines on my chart, which some traders do not like. I do not use a real chart straight away because I want traders to get a message fast, and then we'll go on the chart and do a real demonstration on a live chart, and also for swing trading purposes, so traders may see for themselves. So do not disregard this video because I'm drawing on my chart. I have a reason for it. Get a message first, understand it first, the knowledge first, and then the practice. Okay? If you like this video, please give us the thumbs up. Dislike it, we want to know. Please give us the thumbs down. All right? If you love this video, feel free to share it on Google+, on Twitter, and also on Facebook. Until the next time, enjoy yourself and be very happy. We are the TSTW24 traders talking about how to combine wave principle and divergence, part 1. See you in part 2.